Let me start with a real story. In 2008, the S&P 500 fell around 38.5%, with reds across sectors like tech, financials, and industrials. And yet, that same year, Walmart's stock went up 18%. McDonald's returned about 6%, including dividends, and Dollar Tree surged 60%. Aside from stocks, gold was also up by more than 5%. This wasn't a coincidence, and nobody had inside information. It's a pattern that repeats across every major recession in modern history, and today I'll explain exactly why it happens and what you can do with that knowledge right now. Now, I won't be recommending any specific stocks in this video, but what I'll be giving you is a framework, one that works today and will still work 10 years from now. My name is Phoebe, and you're watching Trading Key. Why this matters right now. Over the past few months, a few things have collided at the same time. Middle East tensions have kept oil prices elevated, with Brent crude trading back above $100 per barrel. And when energy costs rise, inflation follows. And when inflation is sticky, the Federal Reserve is stuck. Raise rates and you slow the economy, don't raise them and you lose the fight on prices. Goldman Sachs recently put the 12-month recession probability at around 25 to 30%. While JP Morgan is sitting at 35. What's more, retail investor bearish sentiment has been well above the historical average. So a lot of people are already worried about a recession, but the recession hasn't actually started yet. And that gap between fear and reality is exactly the right moment to understand defensive stocks. Because once a recession is officially underway, prices already reflect it, and the opportunity has already passed. Cyclical versus defensive stocks explained. Here's the core framework, and everything else in this video builds on it. Cyclical stocks are companies whose business moves directly with the economy. When times are good, consumers spend freely and earnings look great. But when times are bad, consumers pull back. And so companies like airlines, auto manufacturers, and semiconductors feel it first. People buy those things when they have money to spend, and when they don't, they stop. Defensive stocks, on the other hand, are companies selling things people need regardless of how the economy is doing. Demand barely moves in a recession, revenue stays relatively stable, and the stock price holds up or even goes up. The classic defensive sectors are consumer staples, meaning grocery stores like Walmart, food and beverage brands like McDonald's, and discount retail like Dollar Tree, which actually benefits as consumers trade down to cheaper options. Then there's gold, which isn't a stock but is one of the most reliable defensive assets. Its protection doesn't come from stable cash flows, but from the reliability of being the asset people run to when they stop trusting everything else. When faith in currencies erodes and banks start looking shaky, gold becomes the default. Recapping the 2020 COVID crash. From February 19th to March 23rd, the S&P 500 dropped 34% in just 23 trading days, which made it one of the fastest drops into a bear market ever recorded. But the recovery was equally remarkable. The market clawed back all its losses within 5 months and finished the year up 18.5%. The winners in 2020 looked different from 2008, because this crash wasn't about structural rot in the financial system, but a pandemic. Energy fell over 37% as global travel ground to a halt, but Amazon gained 76% because lockdowns turned online shopping and cloud computing from conveniences into necessities. For much of the American economy, Amazon had become infrastructure. Gold gained roughly 25% that year, as the Federal Reserve nearly doubled its balance sheet in a matter of months. And when people worry about what printing that much money does to the long-term value of their currency, gold absorbs that fear. The key takeaway here is that defensive stocks don't always mean the same companies every time. In 2008, the winners were brick-and-mortar discount retailers, whereas in 2020, digital infrastructure was the defensive play. The question is always which sector provides something people simply cannot do without in that specific crisis. The math of losing less. Here's a calculation that most people have never actually worked through, and it's worth a minute of your time. Portfolio A drops 50% in a recession, which means you now need 100% gain just to get back to where you started. Portfolio B drops 15%, so you only need about 18% gain to recover. When the market bounces 50% from the bottom, Portfolio A only gets back to 75% of your original balance, which means it's still underwater. While Portfolio B is already at a new all-time high and up by 27.5%. The historical data confirms this. Using 2008 through 2010, for instance, the S&P 500 returned a negative 37% in 2008, then up 26.5% and 15% in the 2 years that followed. Meanwhile, the Consumer Staples Exchange Traded Fund XLP returned a negative 15% in 2008, then up 14% and 13% over the same 2 years. Let's say you put $1,000 into each at the start of 2008 and leave it completely untouched for 3 years, and the S&P side ends at roughly $920, while the XLP side ends at roughly $1,090. Even though the recovery years were actually stronger for the broader index, it still never caught up because that 1 year of heavier losses created a gap that compounding couldn't close. That's the whole point. 3 questions for your portfolio. Before I wrap up, here are 3 questions worth running against your own holdings. First, for every company you own, are they selling something people want or something people need? If unemployment rose 2 percentage points tomorrow, would their customers cut back significantly? If the answer is yes, that's a cyclical position. And if the answer is no, it's more defensive. Second, do you actually know roughly how much your portfolio would fall in a typical recession? Consumer staples have historically seen maximum drawdowns of 15 to 30% in major downturns, and healthcare is in a similar range, while financials and cyclical consumer names can fall 50% or more. The question is whether what you're currently holding matches what you can actually stomach. Third, if you're thinking about making a move, is it coming from logic or from fear? Because panic selling everything after bad headlines and rotating wholesale into defensive stocks isn't really a strategy. A logical adjustment means small, deliberate, reasoned rebalancing based on your actual risk tolerance, rather than a full portfolio overhaul at the exact moment the market feels most frightening. How should you protect your portfolio? So here's what we covered today. Markets don't fall uniformly in a recession, and consumer staples, healthcare, and utilities consistently hold up far better than the broad market. This isn't just theory, it's decades of proven data. The reason for this is straightforward. Some things people simply can't stop buying no matter what the economy is doing. They can skip the new car, cancel the vacation, and use the same phone for another year, but they can't skip food, medicine, or electricity. Gold works through a different mechanism entirely. The more chaotic markets get, the more capital flows toward the one asset that sits completely outside the financial system. And losing less compounds. A 20 percentage point gap in drawdown, multiplied through the recovery, produces a real dollar difference that's bigger than most people expect when they actually run the numbers. So, how much of your portfolio is actually built to survive a recession? Let me know in the comments. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key. Give this video a like and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.